Did you know that over the last 20 years, the Nifty 50 index has given a CAGR of 14.9%? Gold, on the other hand, has delivered an average return of 11.2% during the same period. Gold shines brightest during tough times. I don't know who started the argument that since physical gold can be stolen, you should not buy it. If घर के अंदर से गोल्ड चोरी हो सकता है, तो फिर इससे ज़्यादा इजी तो ये है कि घर के बाहर से आपके कार्स या बाइक्स भी चोरी हो सकते हैं. So that logic doesn't stand at all. Gold is often seen as a shield against currency depreciation. You might know that diversification is best achieved by investing in uncorrelated assets. And please stop comparing gold with equities or mutual funds to decide which is better. Rather, consider keeping both in your portfolio. One thing to keep in mind is that physical gold is the real gold. However, this doesn't mean other options like gold ETFs and sovereign gold bonds are not good. There's also a risk of theft or loss in the case of all physical gold options. But then, cars and bikes parked outside your house can also be easily stolen, yet we still buy them, right? Gold ETFs are a modern way to invest in gold. There are no storage or insurance charges, and there's no GST on gold ETFs. Sovereign gold bonds or SGBs are another interesting option. However, do note that if the Indian government goes bankrupt, these bonds become worthless. But in that case, you will have bigger things to worry about. Hello people, I am Suraj Deo and welcome back to Deo Talks. Today we are talking about something timeless, that is gold. Gold has always been a classic investment, and for good reason. It's not just about growing your wealth, it's about having a reliable safety net. Think of gold as your long-term insurance policy, not just a quick investment. So stay with me until the end of this video and you'll learn everything about why gold is a must-have in your portfolio. This video has two sections. First, we will explore why you should invest in gold, including its impressive past performance, resilience during tough times, and its ability to protect your wealth when the rupee loses value. We will also discuss how gold can diversify your investments. Then, in the second half of this video, we will cover the most important aspects of gold investing, including the best options available such as physical gold, gold ETFs, and sovereign gold bonds. We will also discuss the risk and cost of each option. Alright, section 1. Why you and I should invest in gold. Reason number 1. Gold's historical performance and resilience. Did you know that over the last 20 years, the Nifty 50 index has given a CAGR of 14.9%? Gold, on the other hand, has delivered an average return of 11.2% during the same period. In fact, gold has given an average annual return of 9.6% over the past 40 years. You might think that Nifty or Sensex has given a better returns compared to gold. But here's a catch. Gold has performed exceptionally well and outperformed stock market returns by huge margins during uncertain times, such as the Indian currency crisis, the dot-com bubble, the global financial crisis, and the COVID-19 pandemic. You can see on the screen how the Nifty had huge negative returns throughout these periods due to various global events, while gold remained strong in the same period, acting as a reliable hedge against market volatility. So it's fair to say that gold shines brightest during tough times. It often outperforms in periods of high inflation, economic risk, and geopolitical turmoil. Therefore, gold must be a part of your portfolio to support you in these uncertain times. Number 2. Gold is tangible. Physical gold is one of the few assets that is tangible, meaning you can see and touch it. This quality creates a perception of safety among investors. Unlike other tangible assets like real estate, buying gold is relatively easy. Plus, because it's physical asset, gold is safe from hacking and other digital threats. However, investing in gold does come with its own set of risks, such as theft. But in that case, cars and bikes parked outside your house can also be easily stolen. Yet we still buy them, right? I don't know who started the argument that since physical gold can be stolen, you should not buy it. If gold can be stolen from inside your house, then it's even easier for cars and bikes to be stolen from outside. So that logic doesn't stand at all. Number 3. Gold protects against rupee depreciation versus USD. Gold is often seen as a shield against currency depreciation. When a currency like the Indian rupee loses value compared to another currency such as the USD, then it's called currency depreciation. For example, if you need more rupees to buy $1, it shows rupee depreciation. Since gold is traded globally in USD, so when the rupee weakens against the dollar, gold prices usually go up in rupee terms. This means that even if the rupee loses value, the value of your gold holdings in rupee terms could increase, potentially balancing out losses in other rupee-denominated investments. To protect against such currency risk, you should include gold in your portfolio. The idea is that if the rupee depreciates, the rise in value of gold in rupee terms could help offset losses in other parts of your portfolio. Number 4. Gold is great for diversification. You might know that diversification is best achieved by investing in uncorrelated assets. Uncorrelated assets are those assets whose prices don't move in the same direction. Data from the last 20 years indicates that the correlation coefficient between the Nifty 50 index and gold prices is negative, which simply means that when the Nifty 50 goes down, gold prices tend to go up and vice versa. Therefore, gold can be one of the best tools for portfolio diversification, acting as a hedge against the potential volatility of equity investment and also inflation. Number 5. Gold provides liquidity. Gold is extremely liquid because it's always in demand. Investment in gold can be liquidated much faster than other physical assets like real estate. There is no lock-in period in gold investments except for sovereign gold bonds. You can also take a loan against gold in times of need. So now you understand why gold is a smart investment choice. It's stable, strong, and protects against currency fluctuations. The fact that central banks are buying more gold for extra security demonstrates its lasting value. For regular folks like us, adding gold to our investments can reduce risk and provide safety during uncertain times. And please stop comparing gold with equities or mutual funds to decide which is better. Rather, consider keeping both in your portfolio. Each asset class has unique benefits and can complement each other to create a balanced and resilient investment strategy. Now, before we move to section 2 of this video, here's one small request. If you have found this information useful so far, please like this video and subscribe to our community. Your support means a lot. So as you know, gold can be purchased in physical forms like jewelry, coins or bars, or in electronic forms like digital gold, ETFs, sovereign gold bonds, etc. One thing to keep in mind is that physical gold is the real gold. However, this doesn't mean other options like gold ETFs and sovereign gold bonds are not good. Each of them can be suitable for different types of investors. Let's start with the classics, that is physical gold. When you think of gold, you probably imagine jewelry, coins or bars. This is the traditional way to invest in gold because you have that tangible asset you can hold on to and it can be handy in an emergency. Plus, jewelry can have sentimental value. Many people in India, especially in rural areas, prefer gold jewelry due to limited access and a lack of awareness of other investment options. Now, whenever you buy jewelry, make sure it's hallmarked for purity. Also keep in mind that you pay making charges, approx 8% to 35% over the gold price, and a 3% GST which you can't recover when you resell it. If you want to invest in physical gold but wish to avoid high making charges, then consider gold coins and bars. These coins and bars typically have lower making charges ranging from 2% to 10% for coins and less than 0.5% for bars. You will also have to pay 3% GST on these purchases. Remember to always ask for purity certificate while buying this. There's also a risk of theft or loss in the case of all physical gold options. But then, cars and bikes parked outside your house can also be easily stolen, yet we still buy them, right? Another option is to invest in gold ETFs. Gold ETFs are a modern way to invest in gold. They are like stocks that mirror the price of gold, offering a secure and convenient way to get exposure to gold without storage worries. You can easily buy and sell them on the stock exchanges, just like any other stock. Gold ETFs are a low-cost way to invest in gold, with expense ratios typically between 0.3% to 0.8%. To invest in gold ETFs, you need a demat account. You can also consider setting up SIPs in gold ETFs. By buying units monthly or at regular intervals, you can average out your cost and potentially generate healthy returns. Since the gold is held in your demat account, there are no storage or insurance charges, and there's no GST on gold ETFs. Plus, the liquidity of gold ETFs makes them perfect for investors with medium or short-term investment plans. However, there are a few reasons long-term investors should avoid gold ETFs. See, unlike physical gold, which is a tangible asset, gold ETFs come with counterparty risk. This risk arises from the possibility that the other party in the agreement may default or fail to fulfill their obligations. One of the main benefits of gold is that it is not simultaneously someone else's liability. But gold ETFs do not provide this assurance, making them a less reliable substitute for physical gold for long-term investors. Sovereign gold bonds or SGBs are another interesting option. India is the second largest consumer market for gold jewelry, but still produces the minimum quantity of gold. To meet the demand, the country needs to import gold. And to reduce the burden of import, the Reserve Bank of India or RBI issued sovereign bonds on behalf of the Indian government for the first time in year 2015. These are government-backed bonds that are linked to gold price. They offer a guaranteed interest rate of 2.5% per annum and with no storage risk or insurance fees. However, there's an 8-year lock-in period, so you cannot cash out early unless you find a buyer on the secondary market after 5 years. You can invest in SGBs with as little as 1 gram and up to 4 kilograms per year. And you can buy SGBs during specific windows announced by the RBI. These buying windows are open for 5 days and you can find the date list on the RBI website. But don't worry if you miss these windows. SGBs are also traded on stock exchanges, so you can easily invest in them just like you buy shares through your trading account. You can also buy them from post office and banks. There's one question people generally ask: can I convert SGBs into physical gold? The answer is no. SGBs can't be converted into physical gold. Redemption is done in Indian rupees only. However, do note that if the Indian government goes bankrupt, these bonds become worthless. But in that case, you will have bigger things to worry about. So till now, we discussed the 3 best options for investing in gold. Now let's talk about the 3 key factors to consider when investing in these gold options. Number 1. Risk in gold investing. Let's discuss the risk associated with investing in gold. First up, physical gold. While holding physical gold can feel secure, it comes with risks like theft, tampering, and losses during the making process. On the flip side, digital gold is convenient and you can buy it online from platforms like Google Pay, Paytm, PhonePe, etc. But here's the catch. There's no regulatory oversight in digital gold. Yes, no SEBI, no RBI, and no one to keep an eye on how these companies operate. So while digital gold has its perks, the lack of regulation is definitely a big downside. If we talk about gold ETFs and gold mutual funds, they are a bit safer, except for the counterparty risk which we discussed earlier. Gold ETFs are backed by physical gold and are regulated by the government, which is a huge plus. Gold mutual funds usually invest in one or more gold ETFs. So it's like an extension of ETF model. The gold for ETFs is stored securely in custodians' bank vaults and gets valued regularly according to SEBI guidelines. This regulation and the fact that they are backed by real gold makes these options quite reliable. Sovereign gold bonds or SGBs are a different story. You might be surprised to learn that SGBs are not backed by physical gold. When you put your money into an SGB, it's basically the RBI saying they will pay you the bond's value at maturity, which is pegged to the gold price at that time. Unless the Indian government defaults, SGBs are pretty safe. So understanding all these risks is super important. Physical gold has its issues with theft and quality, while digital gold's main concern is the lack of oversight. Gold ETFs and gold mutual funds being regulated and backed by actual gold offer a safer bet. And while SGBs are not backed by physical gold, they are still a secure government-backed investment, unless something drastic happens. Number 2. Cost involved. Let's talk about cost now. When it comes to physical gold, especially jewelry, you have 3 major costs: design and making charges, storage cost, and a 3% GST. Together, these can add up to even 40% to the overall gold price. Plus, don't forget insurance and bank locker charges. These costs make physical gold less attractive for returns. Next up, gold ETFs. These have an expense ratio of 0.3% to 0.8%, plus other costs like brokerage and demat fees. Gold mutual funds might seem similar, but their actual expense ratio includes both their own cost and the cost of the ETFs they invest in. The gold mutual fund manager collects money from multiple investors and invests it in gold ETFs. The gold ETF manager then buys physical gold and stores it in custodian's vaults. So there's a double expense ratio in the case of gold mutual fund. Next is sovereign gold bonds or SGBs, which are quite popular as they don't have visible expenses. Yes, there are no cost or charges of any nature when you buy SGBs. In fact, online investors get a 50 rupee discount per gram while buying SGBs. Number 3. Taxes on gold investing. Now let's summarize the taxes on gold investing. So first, you have to pay a 3% GST when you buy physical gold like jewelry, coins and bars. Then you have to pay capital gain tax on profits made in case you resell them. If you sell your gold within 2 years, you will have to pay short-term capital gains tax. That is, profit from the sale are taxed as per your income tax slab. If you hold it for more than 2 years, you pay a flat 12.5% LTCG tax without indexation benefits. Indexation is simply an adjustment to the purchase price of the asset or investment to reflect the effect of inflation, and this adjustment rate is declared by the income tax department. In the case of gold ETFs and gold mutual funds, they are taxed at rates as per your income tax slabs, irrespective of your holding period. The last one, that is sovereign gold bonds, has a unique advantage. The 2.5% interest income is taxable, but capital gains made at maturity are tax-free, whether the SGBs are bought during the launch or from the secondary market. So in conclusion, the top 3 options for investing in gold are physical gold, gold ETFs and sovereign gold bonds. Each of these provides unique benefits and can help diversify your investment portfolio. That's all for now. Please feel free to leave any question or comments below. Thanks a lot for your time and let's take care of this beautiful world. I'll see you next. And smile. Always smile.